Hey guys, it's Craig from Paramount coming to you again with another video. If you watched our previous video, we actually did a post asking people if they have questions that they want us to answer as financial advisors. And one of the questions that came in was how advisors are paid. How in the world do you pay a financial advisor for their work, for their service, and for their advice? So today I'm actually going to talk about that. I'm going to try to keep it high altitude. If you want me to go into the weeds, feel free to reach out to me personally. Happy to have a conversation about it. The goal of this video is to give you as much information as possible. One, how we're compensated, but if you are in the market to hire an advisor or if you're interviewing a couple advisors, you should ask them, how am I going to pay you? And they should be able to answer that explicitly to you or directly to you. So there's really two different ways financial advisors are paid, in the form of a commission or in the form of a fee. And depending how they're licensed or what licenses they hold from a security standpoint through the government, it depends on which one they're able to do, or maybe they're able to do both. But again, I want to talk about just high level how an advisor is paid a commission. For example, inside of the commission standpoint, there's really two avenues. There's something called a brokerage account. If you watched my previous video, I think it was about a month ago, I talked about the different types of accounts that you have. This is also considered an investment account, but you have a brokerage account, and then you also have insurances as well. For example, inside of that brokerage account, you can own or buy something called an A-share mutual fund. So what this means is you pay a fee or a commission to buy into the investment. So for example, a large mutual fund company out there, I'm sure you might have heard of them, they're called American Funds, and they also go by Capital Group as well. If you decide you want to buy into one of their securities, you pay a fee to buy into the investment. Starting out, their fee starts at 7.5%. It's called a front-end sales charge in order to buy into the investment. So for example, if you say, hey, I want to buy $100 worth of American Funds, whatever that mutual fund is through them, your cost is $5.75 in order to buy into that. Now, half of this goes to American Funds for using their investments, and the other half goes to the broker or the advisor for making that recommendation to buy that security. Now, with A-share mutual funds, the more you invest inside of the one company, so the more you have with American Funds, you then receive what's called breakpoints. At $25,000, at least that's their first breakpoint, this cost goes from 5.75% to then 5%. And then you get another breakpoint where it drops to 4.75%, and thereon as you have more money accumulated with that company. The downside with using A-share mutual funds is if you decide, hey, I don't like Capital Group for whatever reason, I want to change to a completely different company, I want to go from American Funds, Capital Group, to Franklin Templeton, you then have to pay another sales charge to buy into that new mutual fund company. Now, if you decide you want to stay with American Funds and Capital Group and just change investments inside of that one fund company, you do not have to pay a new front-end sales charge, which is kind of nice. So you're kind of committing to that one company for a long period of time. The next type of investment that you can hold inside of a brokerage account are stocks. Now, I'm sure you have all seen the movie Wolf of Wall Street, right, with Leonardo DiCaprio, actually one of my favorite videos. He's one of my favorite actors. But the main premise behind that is they're selling penny stocks that offer a high commission. And I'm sure you probably heard or seen commercials on the television or heard a commercial on the radio that says, we don't sell high commission, investments. So really the stockbroker or the advisor, they're paid a commission, and that commission can vary, anywhere from like 1%, to maybe 3% of the total investment. They get to decide how much they want to charge their clients for the commission. Now, each firm that they work for, they might have caps on how much they can charge, but kind of the industry standard that I've seen anyway is 1%. So if you decide you want to buy, again, $100 of, a stock XYZ company, times 1%, your commission that you're paying your broker is $1. But they're also paid if they decide to sell the investment. So if you call your broker up and say, hey, I want to buy Amazon, right? However much you want to buy, they're making probably 1% on that, right? For purchasing the investments for you. But on the flip side, if you call them and say, hey, I want to sell that Amazon stock, they're also paid again another commission for that transaction. So it's very transactional based. So you can kind of see, and this is actually one of the reasons why at Paramount we decided to drop one of our licenses where we're not able to use these type of investments. We can still sell stocks inside of this account over here, which I'll explain a little bit, but we do not sell any types of investments that pay us a commission, because we really wanted to further remove ourselves from any potential conflicts of interest or ethical dilemmas that you have as a financial advisor with transactional business. Now, inside of the brokerage account, there are other types of investments that you have. I can go in a little more in depth on that if you want to, reach out to me personally, but I just kind of, again, wanted to keep it high altitude of the most common investments that you hold inside of these type of accounts. The next part I want to talk about is the insurances. Again, high level, because the way we're paid through insurances is honestly, it's the craziest thing in the world. Trying to keep it all straight, it makes your head explode. So I'm going to keep it very high level here. So for there's really 4 main types of insurances: life insurance, disability, long-term care, and annuities. Life insurance, you pass away early. Disability, you can no longer do your job. Long-term care, you go in a facility. Annuities are types of insurances that's like against longevity risk, that you're living too long. So the way that we're paid as advisors, or I should say life insurance brokers, is usually a percent based on your premium. Now the fancy term is target premium, but so for example, if you're alive and healthy and you get a great health rating because you have no health risks, advisors are actually paid less because your premiums are a lower amount, versus if you're, have health issues, diabetes, high blood sugar, you're older, your premiums are higher, so advisors are actually paid a little bit more. So typically, the advisor is paid a commission from the insurance company. So it's not the client paying us the commission directly, it's the insurance company paying us a commission based on us making the recommendation for the client to use that certain insurance company. And also depends on what company you work for. If you are an independent advisor or you work for a corporation, you can get paid anywhere from 55% to 110% of the premium. So what I mean by that is, if say you're paying, again, easy math, $1,000 a year for the life insurance policy, the advisor can get paid 55% of that, which is $550, or 110% of that, which is $1,110. Now, this is only a one-time thing that they get paid. They get paid this once, and then that's it, typically. Sometimes there are products that pay you a trail, which is, as long as the client continues to pay, you might get a smaller percent, but typically it's, 55 to 110% of the target premium, or how much you pay initially the first year, and then that compensation stops. So it's like a one-time thing. For annuities, completely different story. There's something called different commission options that advisors can pick. They can choose to say, hey, I want all the compensation up front in the first year, or I want to take a commission option 2, which could be like a smaller upfront commission, but then they get paid a trail for the rest of their life. A trail meaning they get paid, keep getting paid commission for forever as long as the client holds it. So again, I'm going to keep this high level, but happy to go into it a little bit further. So the way annuities work, there's really, what we call fixed annuities, and then variable annuities. Fixed meaning there's no investment risk. You're not investing in the stock market. Variable meaning you are invested in the stock market in what's called sub-accounts that act like mutual funds. So fixed accounts or fixed annuities, again, you get paid a percent based on how much the client is investing from the insurance company. So the client's not paying the advisor directly. You can get paid anywhere from 1% to technically 7% commission based on how much you're investing. And same with the variable annuities. Typically, they're a little bit higher because you're locking your money in for a longer period of time. You can get paid anywhere from 3% to 7%. So it seems like a pretty high amount. So again, just as an example, if you put $100,000 into a variable annuity or $100,000 into a fixed annuity, depending on how long you're committing that period of time with that insurance company, that commission can be anywhere from $1,000 to $7,000. And then same with the variable. It could be anywhere from $3,000 to $7,000. Now, this doesn't mean that the advisor gets this full amount. there's what's called house splits, which means the company that the advisor was representing, they might get a cut of this as well. And depending on that agreement between the advisor and the firm that you work for, they might only receive half of that as well. But $3,000 to $7,000 for using a variable annuity approximately, and then for a fixed annuity, depending on what type, could also be like 1% to 7%. So pretty wide range there of the different types of commissions that advisors can use. And again, we aren't licensed anymore to use variable annuities on the commission side. We can use them and fixed annuities on the advisory side, which I'm going to talk about next again, but we don't use any types of variable accounts that pay us a commission. We can only use those under the advisory account because, again, we wanted to further remove that conflict of interest that we might have and saying, well, hey, I can use both of these options, could work for the client, but then you kind of have that ethical dilemma on, well, as an advisor, I can get paid more if I use this. So it really creates a conflict of interest. That's why we decided to drop one of our licenses where we can no longer use this type of commissionable investment. And then the last two types of compensation advisors receive are typically through fees. This can either be through an account, an advisory account where the advisor is managing the account that's in your best interest, acting as that fiduciary, and they're paid what's called a percent of the asset under management, or a wrap fee. It's all inclusive. It's all included in the fee. Or they can also be paid through like a consultation fee. It could be like an hourly rate, could be a per plan fee, like a financial planning cost, etc. So the way an advisor is paid in this type of an account, it's typically under, again, assets under management. And this fee is what the advisor decides to charge the client. The average advisory cost is typically 1.5%. That's kind of the average advisory fee in the United States. I've seen as low as 0.8%. But this fee can vary depending on the advisor you work with, the firm you work with, and what they decide they want to charge. So an example would be, say you have a $100,000 account balance. If the advisor is charging on the low end 0.8%, your cost per year is $800, and that's per year. That's going to the advisor. Or if they're charging on the high end, that 1.5%, your cost is $1,500. That's going to the advisor. Now, the advisor might not receive this full amount, depending on what firm they work with, the house cut that they receive. They may only receive half of this. They might receive the full amount. They might receive a large percentage of that. But this is the explicit fee that you as the client sees on your statements, because we have to fully disclose that to you with the type of an account that you're using. Now, as I mentioned before, in the brokerage accounts, you can have stocks, you can have mutual funds, exchange trade funds. You do have something called expense ratios in order to be invested in those, but this is the explicit fee that the advisor charges in order for them to manage the account, to give you the advice and guidance that you're looking for. And then lastly, can be potentially hourly rates or financial planning costs. A financial advisor can say, hey, I'm charging you $100 per hour in order to get you in the door, talk about goals, objectives, budgeting, whatever you're looking for. It could be higher than that, depending on the advisor as well. And then you also have something called financial planning costs. Now, these are typically one-time fees, one-time costs in order to start the financial planning process. I've seen as low as $1,000. I know a firm, they have a $15,000 minimum that they charge. Now, these are typically higher net worth clients that require more skill set, estate planning, et cetera, and tax planning and such. But really, this just depends on, again, the advisor that you're hiring, and then what different services they're offering for the fee that you're paying. Now, as at Paramount Financial Planning, the word financial planning it's in our name for a reason, because Zach and I are so passionate about doing financial planning with clients, really uncovering what values you cherish the most, what makes you do the things you do every day. But also, we absolutely love the financial planning because we believe that if you're just throwing money into an account, we don't really know if you're actually accomplishing your goal or working towards the goal. So that's why we always start with the financial planning first, which we charge for that in order to do the financial plan, but we fully disclose the costs, the different services, the different conversations we do with those. And the reason why we charge a planning fee, it's because we view our firm as kind of like a school bus. We only have so many seats on our bus, where we want to make sure the clients we bring on to Paramount, we're committing toward, to a long period of time. Hopefully 20, 30, 40 years is really our time commitment for the client, because we really don't want transactional relationships. We're really trying to really deepen those relationships with the clients to make them long lasting as possible. And for us, we don't have account minimums. So sometimes when you're just working with an advisor under the advisory account, they might say, hey, you need to have a minimum of 50 grand before I'll talk to you, or 100,000, or sometimes when you get to the larger firms, 250 or 500 grand before they'll even have a conversation with you. It's so important to us to make sure that we are accessible to the clients that really want that accountability and need guidance, which is why we charge the financial planning fee first, because it's kind of like a way for us to make sure that the clients are serious about taking our advice and our guidance. But we don't have account minimums. We have personality minimums, though. We have to make sure that we work well together. Hopefully that brought some clarity to you in the terms of how financial advisors paid, from commissions to fees. As always, feel free to send us a message if you have any further questions, or send us an email, plan@planwithparamount.com, or give us a call, and let's find out what we can build together.